Welcome back. You should just keep your eye out on Hyundai Motor because today the 6-month lock-in of its IPO, shareholder lock-in, will come to an end and a fairly large amount of shares will get released. So according to Nuvama, nearly 50 crore shares of the company, which is worth about $9.5 billion, will become eligible to trade. The 6-month and beyond lock-in will come to an end today, and that's about 60% of the company's outstanding. So that's Hyundai Motor, which you should keep on your radar. But let's welcome Nitin Raheja on the show now. He joins us from Julius Baer, India. Thank you very much for joining in. Nitin, your call for a while has been, bullish on financials. You've been positive, particularly on private sector financials, and now they're the first to get to their record high levels. Where from here? Do you think we've already seen a bulk of the gains, or do you think they are in a structural uptrend, and even at these levels, one can go long and accumulate banks?
So, thank you for having me on the show. But just to, when we talk about financials, I'll just sort of enumerate why we like this sector so much. It's very simple. The sector has been going through a lot of regulatory overhang on the part of RBI. Then you had this whole not structural, I would say, a whole tightening of liquidity in the economy, which came and sort of, hit these companies pretty well. And we've seen deposit growth being tepid. Now, what we are seeing is there is ample liquidity in the economy. We've seen that the regulatory overhang is lessening. And in fact, all the curbs that were coming on unsecured loans, personal loans, we've seen that the net impact, at least when we've seen the two big banks declare their results, has been, we haven't seen a worsening of credit quality. And because of that, we've also seen the RBI roll back some of those measures. So I think with all of that in place, you have these banks sitting very well placed. They've been able to even pass on the cut of repo rates by lowering the deposit rates. We saw that from 1st April onwards. So, and that coupled with the fact that the valuations that these companies in this sector trade at are at probably their lows over the last 10 years. So we've just, in my own view, if there is one place where you can find valuation comfort, at the same time, the upside of growth, that is financials. Now, we are seeing that discretionary consumption is struggling, and the government put in measures as far as in the budget in terms of, increasing the tax threshold, plus a good monsoon and rural. I think you should see consumption come back in the second half. Capex spending should also start seeing an uptick as we go ahead. So I think they're very well placed for growth as far as the balance sheet is concerned, as far as the regulatory framework is concerned. And hence we think that, that space has yet, long legs or a long way to go.
Nitin, take your point completely on board. Banks clearly cheering, especially as far as the last couple of weeks are concerned. You did mention about significant avenues for growth going forward, but in the quarter gone by, especially for a bank like ICICI Bank, were you a little worried about the loan growth, around 13%, slightly lower than what the street was anticipating? And also your view on NBFCs. Do you feel that they would benefit quicker as far as rate cuts are concerned?
Well, to take your second part of the question first, clearly, I think the NBFCs should be the first beneficiaries of rate cuts because they ultimately, are, they borrow, a huge chunk of the borrowing comes from the banks. So I think the NBFC pack should do well. But however, within the NBFC pack, you have to sort of be very, very selective because what we have seen is in each segment, there are a few NBFCs which have excellent underwriting norms. When we look at NBFCs, more than growth, the first thing that I look at is how strong is their underwriting norms and culture. I think that is what clearly, because when you have sources of fund which are higher than banks, and you are actually borrowing from the banks as one of the large source of fund, the spreads that you typically enjoy are leveraged by the fact that you take 5 or 6x leverage and your credit cost being low. So if any NBFC has high credit costs, it invariably lands into trouble. And that's why you've seen since 2018 till now, very few NBFCs generate sustainable wealth. So I think when you look at the NBFC pack, looking at those which have very strong underwriting norms is very important. And I think I agree with you that they will be the first beneficiaries of this. In terms of credit growth, I think we are coming to a realistic level. The fact that the economy is slowing, and those 17-18% growth numbers are going to come down to 13-14% sort of numbers in a particular quarter. If a bank does less than expectations, that's fine, because I think the larger banks will primarily land up doing maybe 1.1 or 1.2 times nominal GDP growth. And if nominal GDP growth is going to average anywhere between 10.5, 11%, so you're probably going to see a 12 to or a 13 to 14% sort of growth number payout as far as credit growth is concerned.
Nitin, with the appropriate disclosure, and you could just say that, could you share some of the top bets that you have in your portfolio that you're recommending?
Well, I'm afraid we are not allowed to talk about stock specific in such forums.
Okay. Any new themes which have emerged?
No, I think I think the big what we are seeing today is across the board, a lot of sectors are seeing a slowdown. At least we're going to see a trend emerge in the first half. But within each of those sectors, you will see stocks do better. So I think I think it's very difficult to call a sectoral theme play out. But if I have to take a little longer term view of the next 1 year, I probably see in the second half consumer coming back. And I think the bottom K, which is, we've seen this K-shaped recovery where premium discretionary has done well. I think the bottom K should start coming back because there are a number of levers that are driving. A, inflation has come down. B, you're going to see, the pay commission wage hikes come into play in the next 1 year. So you should see that happening. And with monsoons being there, I think rural should start doing better. So all of these come together should see in the second half a good festival season, and as far as consumption on the lower K is concerned. So I think that is one other area that we see. But otherwise, we believe that this is going to be a more bottom-up market, even among sectors, whether you take pharmaceuticals, whether you take automobiles, you will see one or two companies doing far, far better. And I think that's the way you'll have to play this market.
Right. Nitin, you've spoken about 3 export-oriented sectors: auto ancillaries, textiles, as well as EMS plays. Given the kind of uncertainty we have around tariffs, how are you approaching this space now? Would you wait for a better opportunity, or are you constructive on them now?
So clearly, the era that we are living in is an era which is going to be, driven by bilateralism. So we're going to see very soon, in the next couple of months, probably the first of these few bilateral trade agreements fall in place with the US. And when that were to happen, you will clearly see some sectors emerging as winners. So if you look at it from an India perspective, right, I do believe that autos is going to be, and auto hanks is going to be a clear, a lot of auto hanks, in fact, have now set up facilities in Mexico, where the US has a more favorable sort of tax agreement. So you will see a lot of auto hanks doing that. Pharma, I think, is going to be around. We are going to see a new deal that will come through. So I think if you're looking at the next 2-3 months, clearly there is a slowdown you will see as far as exports is concerned. In fact, what you might also see as a reverse, that before any of these tax treaties come in, you could actually see the pipeline getting filled. Okay. So you could more aggressive this thing. So you could actually see a good few quarters. And then once the news come, actually the markets start discounting what the news is, the bilateral trade deal is already this thing. So I don't really see too much of a impact on export-oriented sectors over a long period of time.
What's the best way to play the broadening out of the consumption theme? As you said earlier, it was all about premiumization, and we did see, luxury apartments, for instance, like flying off the shelves. But now you expect that with the monsoon, with just better sentiment, the consumption will now broaden out. Would you play it with the staples, the regular HULs and the Britannias, Nestle's of the world, the Daburs, or would you also look at some other themes, for instance, shoes? Right, they've also been impacted at the lower end. What's the best way to play this consumption theme at the lower end?
So I would probably play it through like you said, footwear, apparels, even, for example, two-wheelers. I would probably play it, and affordable housing, and within that, look at affordable housing finance companies, which is actually a great proxy play for that.
Thank you so much, Nitin, for joining us, giving us your view on a whole range of sectors and the fact that you continue to like a few export-oriented sectoral themes. Thanks so much for joining us once again. Well, we now slip into a short break. More stock-specific action on the other side.